Hello, all. Welcome to the world of risk. First of all, thank you so much for all the love and support that you have shown in the first video. So, we have successfully crossed 100 subscribers, and let's hope to see this trend and let's make this channel a hit. And I'll be sharing all the things that are related to risk in this channel. I'll try to cover as much as possible. Please comment down whatever topics you would like to see in the future. So, thank you again for all the subscribers. So, let's begin today's topic. So, today's topic would be basically the 2008 financial crisis, from where this started and how risk management came into being. So, let's dive into the topic. So, 2008 financial crisis. So, what happened basically? So this started with the dot-com bubble. After the dot-com bubble burst, so what is the dot-com bubble? Let me give you a quick background. So dot-com bubble was something in where investors started pouring their money into the internet-based companies or internet-based stocks. So too much money was poured into it. However, the returns were not at that way, and due to oversupply, there was a fall in these stocks, and the stock market lost 5 trillion US dollars. So after this, the organizations in the US or the financial organizations over there wanted to make money. So once this was done, they looked at the next best possible way to make money, and it was mortgages. So what happened was that during this time, since the economy fell, the government went ahead and started reducing the interest rate so that people in the economy could borrow more and spend more. So this is also known as the monetary policy, where governments fluctuate the interest rates based on the economic condition so that the economy is smooth. This is known as the monetary policy. So this was done where the interest rates were reduced and people started to take more loans because cost of borrowing was less to buy more houses. And as we know that buying a house is an investment, or say it is emotionally related to us. So people went ahead and purchased the houses and the economy started growing. So why was this bad? It looks good. People are buying, people are taking loans, economy is going up. So there were mortgages given by the banks, interest rates were down, and people started, more and more people started taking loans. Now, why is this bad? So, what happened is these financial institutes started providing loans to these buyers, right? Also, they saw an influx of buyer coming to them, more and more borrowers coming to them and taking loans. So, what the institutions started doing was they clubbed all these loans into complex products and started selling them to the investors. The investors were happy because they got products in which they got returns. Investors started demanding more such kind of complex products from the banks. These were known as mortgage-backed securities. We will be covering this down in our lectures. So investors were happy, they got more returns from this. Banks were happy, or the institutions were happy because they were getting to sell this to the investors. Now what happened was initially these institutes made the complex products out of mortgages given to people who had a good credit rating. Now, as demand started increasing, financial institutes did not have so many credible borrowers. So what they started doing is they targeted low income people and people with low credit checks or low credit worthiness, because investors kept on demanding these products and they were not able to supply. So they started giving everybody loan and make these complex product out of these mortgage loans. And investors were also happy, they were getting product, bank was happy, people were happy, they were getting loans at lower interest rate, and they were able to buy houses. The common belief that was there was that within the investors were that even if the borrowers who took loan failed or defaulted, they had the asset house which was backed. was available to cover the price. The prices were going up, and it was available to be sold in the market to cover the losses. So they were buying more and more. Now what happened is, suddenly, say one borrower failed to repay the debt, and the financial institute took away his house, listed in the market, and there was the house available for sale. Initially, those houses got sold because the housing prices were increasing and people were buying more and more houses. However, when this trend started to continue, more and more people started to default, more and more houses came into the market, more and more possessions were with the banks. So there was a oversupply of houses, and people were not, there were not so many people willing to buy, on there were no more buyers available in the market to buy these houses. Moreover, say I have a house which was valued at say $1 million or say $500,000 during that time, and I took a mortgage against that amount, and I was paying a very high say loan or EMI. So once these housing prices came crushing down, because there were more and more houses available in the market, so the housing prices came down. So once these housing prices came down, I, as a borrower who took loan from the bank, was really worried that why am I paying so high amount of EMI or mortgage on the house which whose value have decreased suddenly, and whose value came to half of what was actually. So what people like me did was they moved away from these houses. They went to the banks or financial institutes and told that you can keep the house. I am not going to pay a mortgage. So from one side, people were defaulting, and from the other side, people went ahead and surrendered their houses or their assets and told that we are not going to pay mortgages. So this led to crisis. There were assets also, there were so many houses available, there was no mortgage payment, and investors also started to default from not buying this complex product, because they knew the housing prices fell and there were no returns to be made. So from all the way, these financial institutes were stuck with more property, more less mortgage, and slowly the money flow did not happen, and so big financial institutes got bankrupt. So this is the like let me show through you a slide. So there were more and more houses available. No buyers were available in the market. This led to no sale, and from these houses, no mortgage payment came to the bank. And since there was no sale, no money flow came to the banks. So financial institutes finally started to bankrupt. So this is what happened in the 2008 financial crisis, where there was a oversupply of this housing, but there was no demand. So this is also known as the housing bubble burst. So that's it for today, guys. Thank you all once again. So please like, share, and subscribe. This really helps motivates me to make more and more videos. Also, comment down whatever topics you want to see. In the next video, we are going to go through a act or regulation that came from this crisis. So here the government came and kind of bailed all the institutes out. So what regulations were there and how it came to being, we are going to see in the next lecture. So thank you once again. Have a good day ahead.